Here is something that should be getting far more attention than it currently is. The foreclosure machine is turning back on across the United States, and the numbers out of 2025 are the kind that stop you cold. Lenders are repossessing homes at a pace that echoes one of the darkest chapters in recent American financial history. A foreclosure happens when a borrower misses enough consecutive mortgage payments that the lender steps in and reclaims the property. That process accelerated at a disturbing rate last year. Foreclosure activity in 2025 climbed 14% compared to the year before. 1 year. 14% more American families losing their homes, and the total scale of this is significant. In 2025, a total of 367,460 properties across the country were hit with some form of foreclosure filing. That means they entered the legal process at some stage, whether that was a default notice, a scheduled auction, or a completed bank repossession. Not every property in that pipeline ends up fully repossessed. Some owners manage to sell before the bank takes over. Others negotiate what is called a short sale, where the lender agrees to accept less than the full amount owed. And a portion of those homes get picked up by real estate investors who settle the outstanding debt, acquire the property, and allow the previous owner to walk away without a repossession permanently on their credit record. It's not a great outcome, but for a lot of people, it is the only exit they have available. The underlying driver connecting all of this is what happened in the American labor market last year. By nearly any honest measurement, 2025 produced one of the worst job markets this country has seen, going all the way back to 2003. When you combine the extremely low rate of net job creation with the 14 million layoffs that were processed during the year, you are looking at a labor market that put millions of households under direct financial stress. People who lose income lose their ability to stay current on their largest recurring financial obligation, which is the mortgage. The pathway from job loss to foreclosure filing is not complicated or long. It is direct. And if labor market conditions weaken further through 2026, there is every reason to expect foreclosure activity to intensify rather than settle down. This data is not a one-time blip. It is a signal worth taking seriously. Now, before we go further, something needs to be acknowledged directly. Every foreclosure in that 367,460 total represents a family going through a genuinely painful financial ordeal. Losing a home is not a small thing. It affects credit, stability, and quality of life in ways that take years to recover from. But we also have to be honest about the market consequences that follow, because the ripple effects move in more than one direction. When foreclosed properties hit the market, they typically sell for less than comparable homes in the same area. Part of that is purely about condition. Homeowners in financial distress almost always start cutting back on maintenance long before they miss their first mortgage payment. Upkeep gets deferred, the yard gets neglected, repairs that should happen get pushed back for months, sometimes years. And the mortgage payment is almost always the very last bill that stops getting paid. By the time the bank lists that property, it usually needs real work, and the asking price reflects that reality. For existing homeowners with equity to protect, more foreclosures in their neighborhood is genuinely bad news. Distressed sales pull comparable values downward, visible blight spreads, and over time, the properties around those foreclosures absorb some of the same downward pressure on their own estimated values. But for anyone who has been waiting on the sidelines because housing has been out of reach, this trend creates an opening. Affordability metrics were already beginning to shift in a more favorable direction during the latter part of 2025, and a rising supply of foreclosure inventory can push that movement further toward buyers. That said, foreclosed properties are not straightforward purchases. They come with complications. Title issues, unknown repair costs, limited inspection access, and extended closing timelines are all part of the process. Going in without preparation is a mistake. What is equally important to understand is what foreclosure spikes tell us about deeper economic conditions. Higher property tax bills across the country, escalating homeowners' insurance premiums, and the accumulated cost pressure of owning a home in this environment all pushed owners over the edge. When income cannot keep pace with ownership costs, something breaks. And those breakdowns do not stay contained to the housing market. A household struggling to make a mortgage payment is not eating at restaurants. They are not buying holiday gifts. They are not planning vacations. Consumer activity at that household drops across the board, and that contraction ripples outward through the broader economy. When you look at which states took the heaviest foreclosure load in 2025, the rankings tell a story worth paying close attention to. Florida led the entire country with 1 out of every 230 homes caught in some stage of the foreclosure process. Delaware ranked second at 1 in every 240 homes. South Carolina placed third with 1 in every 242 affected. Illinois and Nevada both posted ratios of 1 in every 248 homes with an active foreclosure filing. The geographic spread of this list is significant. Florida showing up at the top of this ranking is consistent with what has been happening there for the past couple of years. The state is effectively ground zero for housing stress right now, with a combination of property tax escalation, insurance premium increases, and affordability pressures compressing from multiple directions simultaneously. But Delaware and Illinois are a different story. These are not Sunbelt markets riding a speculative boom into a correction. Delaware is a small northeastern state. Illinois has seen home values generally continue to rise in many markets. The appearance of both states near the top of a national foreclosure ranking makes a clear statement that this problem is not limited to regions with overheated markets cooling off. It is following income weakness and cost pressure wherever those conditions exist, which turns out to be everywhere. On the city level, the metros seeing the most severe foreclosure activity right now include Cleveland in Ohio, Columbia in South Carolina, Lakeland and Jacksonville in Florida, Las Vegas in Nevada, and Chicago and Orlando. Now, Rob Barber, who is the CEO of Atom Data, the organization behind most of this data, has framed the current trend as a normalization process rather than an alarming new development. And there is some legitimacy to that position. During the pandemic, foreclosures were essentially suspended. Forbearance programs allowed millions of borrowers to stop making payments without facing any enforcement action for an extended period. And as recently as 2 years ago, the FHA was effectively absorbing mortgage payments for certain at-risk borrowers to prevent filing numbers from climbing. All of that government intervention held the foreclosure data at an artificially depressed level for years. What we are seeing now is some of that suppression being lifted and normal market consequences being allowed to occur again. The normalization explanation has merit, and it is important to understand the context it provides. But it does not tell the complete story, and it should not be used to dismiss the underlying deterioration happening in household finances across the country. Here's what should actually sharpen your attention. The data at the tail end of 2025 was not moving towards stabilization. It was moving in the opposite direction. In November of 2025 alone, there were 35,651 foreclosure filings recorded in a single month. That figure represents a 21% increase compared to November of 2024. Month over month, same calendar month, 1 year apart, a 21% spike. If economic conditions continue to weaken into the first and second quarters of 2026, the full-year foreclosure total for this year has every chance of surpassing what 2025 produced. That is not a fringe scenario. It is the logical extension of the current trajectory if nothing changes. These are numbers that deserve a close eye as the reports come in throughout this year. Now, there is a consequence of all this housing pressure that is not getting the coverage it deserves. It involves where Americans who cannot stay in their homes or who cannot qualify for conventional rentals are actually ending up. And the answer, for a growing and underreported segment of the population, is extended stay hotels. According to CBRE Analytics, extended stay hotels now carry the single highest occupancy rate of any hotel segment in the entire United States. Traditional hotels run at roughly 60% capacity. Extended stay properties are averaging between 70 and 80%, and a substantial share of the people filling those rooms are not travelers. They are residents. Extended stay properties are structured around monthly pricing and come with kitchen setups, which makes them function almost identically to an apartment from a practical standpoint. And the length of stay data confirms that this is residential behavior at scale. According to the American Hotel and Lodging Association, over 40% of extended stay guests are staying longer than 30 consecutive days. Nearly 20% surpass the 90-day mark. Here is where the economics of this situation become particularly difficult. For many of the people living in extended stay hotels right now, this is not a cheaper alternative to renting. It is more expensive. Based on 2025 averages, the nightly rate at these properties runs between $90 and $120. That translates to a monthly cost of between $2,700 and $3,600. Some of these properties do not even include the kitchen, that is typically the defining feature of the category. Beyond the cost issue, the legal protection available to an extended stay resident is dramatically weaker than what a conventional tenant has. Landlord and tenant laws do not apply in a hotel setting. There is no lease protecting your right to remain. A hotel can remove a long-term resident essentially at will, without any of the eviction processes that a landlord would have to follow with a traditional tenant. The stability of this arrangement is genuinely thin. But the people ending up in these situations are not, in most cases, making a freely chosen lifestyle decision. They are there because the standard rental market rejected them. Credit history issues prevented them from passing the screening. They could not come up with the deposit. A prior eviction on their record made most landlords unwilling to take a chance on them. They needed housing on a timeline that no lease-based option could accommodate. Or they had just gone through a foreclosure and needed a place to land while they figured out the next step. California is experiencing this at a scale that is hard to ignore, specifically in Los Angeles County, where as of 2024, an estimated 20,000 residents were living on a long-term basis in motels and extended stay hotels. These are not people between apartments for a few weeks. Many of them are families with children enrolled in local schools. Many of them work full-time jobs. The paycheck arrives every 2 weeks and still is not enough to break through the qualification requirements for a conventional rental unit. Florida is facing the same pressure. School enrollment records are one of the clearest indicators of how widespread this has become, because families with no fixed address list the hotel as their primary address when registering children. That data reveals a housing crisis that the hotel occupancy statistics alone do not fully convey. There is also a statistical distortion here that consistently understates the problem. Extended stay hotel residents are not counted in official homeless population figures because they technically have a roof over them. But the precariousness of their situation, with no lease, no tenant rights, and monthly costs that prevent them from saving toward stable housing, describes something that is functionally very close to housing insecurity. Shifting now to a completely different dimension of the housing market, one that is going to become increasingly significant over the next decade and a half as the demographic math plays out. Discussions about housing inventory typically focus on new construction pipelines and the flow of existing homes coming off the sidelines. But there is a large and growing source of inventory building quietly beneath those numbers, which is the transfer of residential real estate from baby boomers to their heirs. The data on what happens to inherited homes is consistent and striking. Research shows that approximately 75% of inherited properties end up being sold rather than kept by the person who receives them. When you multiply that rate by the scale of what is coming, the impact on the housing market over the next 15 to 20 years is substantial. Trillions of dollars in total wealth are expected to transfer from the boomer generation to younger Americans across that time frame. And a disproportionate share of that wealth is not sitting in brokerage accounts or cash savings. It is locked inside residential real estate, which means that millions of heirs are going to receive keys, not liquid assets. And keys come with obligations that cash does not. Real estate is not easily convertible. A standard listing process takes weeks to months. The property sits in a fixed location that may have no connection to the heir's current life. It requires continuous maintenance to hold its value, and the carrying costs, including property taxes, insurance, utilities, and routine upkeep, accumulate every single month, regardless of whether anyone is living there or actively trying to close a sale. For heirs without significant financial reserves, managing those ongoing costs during the sale process can be genuinely difficult. And that difficulty is common, not exceptional, because the concentration of boomer wealth in property rather than liquid assets means that a large portion of the heirs receiving these homes will not be in a strong financial position to carry them. Estimates suggest that more than half of the total generational wealth transfer coming from baby boomers will take the form of housing equity, not cash. There are also property-level factors that reduce the likelihood of heirs wanting to keep what they receive. Location mismatches are extremely common. The childhood home is in a suburb or a small town where the heir has no professional ties, no social network, and no practical reason to relocate. Size mismatches are equally common. A 4-bedroom house designed for a family with multiple children does not align with the needs of a 35-year-old who does not have children or plans to have them, and has no interest in maintaining that much property. Younger generations are also, broadly speaking, more oriented toward flexibility and lower fixed monthly costs relative to income. In many markets today, the monthly cost of renting still makes more sense financially than the cost of owning, which further reduces the motivation to hold an inherited property long term. And then there is the dimension that no financial analysis can fully account for, which is the emotional weight of selling a home where someone you loved spent their life. Going through possessions, making decisions about objects that carry memories, navigating the attachment that builds up in a place you knew as a child. That process is not a spreadsheet problem, and it cannot be rushed without real psychological cost. Some families sit in paralysis over inherited properties for years, paying carrying costs month after month, while unresolved grief and family disagreements stand in the way of any decision. Probate proceedings add another layer of delay and expense. When multiple siblings inherit equal shares of a single property, reaching agreement on a sale price, an agent, a timeline, and cost-sharing for ongoing expenses requires coordination that is genuinely difficult to achieve when emotions are running high and financial interests are not perfectly aligned. The contrast with wealthy households is instructive. Financially sophisticated families with proper estate planning typically restructure ownership well in advance, create living trusts, and ensure that the legal and financial transfer of the property at death is clean and unambiguous. Their heirs do not face months in probate court or family conflicts over assets that have no clear documented plan. Average American families rarely have that infrastructure. If you are a boomer holding a home that will pass to your children, the most useful thing you can do right now is ask honestly whether your heirs are financially positioned to handle that inheritance, and whether you are leaving them a gift or a burden. A living trust, a properly drafted estate plan, and a direct, honest conversation with your family about the reality of what is involved could save years of stress and significant money. There is one more dimension to the financial pressure American homeowners are facing right now, and it connects to a growing trend that is worth addressing directly. A rising number of property owners are seriously evaluating whether to cancel their homeowner's insurance entirely. And the reason is premium costs that have climbed to levels that are genuinely difficult to absorb on a household budget. Consider the scenario that is motivating this conversation for many people. A homeowner paying $4,000 per year in insurance premiums against a policy carrying a $5,000 deductible. The math there means that in any claim scenario, the out-of-pocket exposure reaches $5,000 before the insurer contributes a single dollar. Meanwhile, the annual cost of carrying that policy is $4,000 regardless of whether it is ever used. The frustration behind that combination is understandable. But the risk of going without coverage is real and is not evenly distributed. A major structural event, a fire, severe storm damage, or a serious water incident can generate repair costs that would be catastrophic for households without substantial emergency reserves. Florida homeowners have seen this play out in painful detail through recent hurricane seasons, where widespread claim denials and systematic underpayment by insurers left homeowners with damaged properties and depleted savings, and in many cases, set them on the path directly to foreclosure. Having a policy in place and being protected by it are not always the same thing. But despite the risks, a large number of American homeowners have already made the decision to go without coverage. According to LendingTree, approximately 1 in every 7 homes in the United States currently carries no homeowners insurance. Before canceling a policy, there are practical steps worth working through first. An independent insurance broker, rather than going directly to a single carrier, can access a wider competitive range of products and often find pricing that a direct applicant cannot. Ask about discounts tied to your home's construction, roof age, safety systems, and proximity to fire services. Look at bundling homeowners and auto coverage with the same carrier. These strategies collectively can move the premium meaningfully without removing the protection entirely. Raising the deductible is another lever available to most policyholders. Moving to a $5,000 deductible on a reduced premium creates a hybrid model where you are self-insuring the smaller events and relying on the policy only for genuinely catastrophic losses. If you already carry an emergency fund large enough to cover that deductible, this approach may be cost-effective. For Florida homeowners specifically who own their property without a mortgage, there is one additional option worth pricing out. A stripped-down policy that carries flood coverage while excluding wind damage can be structured for properties not located in a designated floodplain at a relatively low annual cost. This only works without a lender involved, because any mortgage requires full coverage as a condition of the loan. But for owners who are free and clear and weighing their options, this route preserves a baseline of protection at a fraction of the cost of a full policy. Whatever you decide, ensure you have a real and accessible emergency fund in place before removing any coverage. The month you cancel is almost never the month you need it, but there is no way to know in advance which month that will be. Plan accordingly, stay ahead of it, and keep watching these numbers as we move through 2026.